Hello everyone, welcome to MyOnlineEdu.com's video tutorial. In this video tutorial, we'll learn how to do risk management in trading. The first risk, the way that you need to manage your risk is you need to always put a stop loss. Okay, so the few disclaimers before I continue with this video, that I am in India right now, so I'll be talking about the Indian stocks, but this is not applicable only for Indian stocks. It can be used, this risk management technique can be used in any trading. It can be share trading, it can be a currency trading, forex trading, it can be derivatives, anywhere. Okay, so and also I'll mention the currency over here is a Indian rupees, INR, but you can take this example as a reference and you can always go ahead and do your own calculation in your own favorite currency, in your own local currency, whatever you use. Okay, so first thing that we assume in this video that you always use a stop loss, but using a stop loss is not enough to manage your risk. How come? Let's take an example. Let's say you are actually taking a trade, 10 trades in a row, and then there are 70% win rate, so you win 7 trades and you lose 3 trades. And here is the trade setup that that you bought in 100 rupees and your stop loss was is 90 and your target was 120. So this was the entry price, this was my stop loss, and this was my target profit. Okay, so let's say you are actually buying in each winning trades, let's assume that with 10 quantity. So each winning trade you are actually entering the trade with 10 quantity, so you are actually having 20 points gain share, so 10 means it will be 200 rupees win, correct? So in the second trade also you win 200 rupees. So like this you win 200 200 200 in each winning trade, total is 1400. So this much you win. After the 7th win you decided, oh, I am winning, that's fine, so let's in the 8th trade I increase my quantity to 50 quantity before entering the trade. Okay, but here let's say on all the next subsequent trades the quantity is 50, but you lose all the 3 trades. So how much you lose per share is 10 rupees, right? So it will be 500 total, 500 rupees loss in each trade. So your total loss is 1500 rupees. So as you can see, even though with 70% winning rate, you lose at the end of the trade, right? Your loss is 1500 and you won actually 1400. So you effectively total you lost 100 rupees, even though with 70% winning rate. So why this has happened? Because suddenly with a quantity you increase the quantity on your losing trades. So here is the good learning factor, that we need to understand that we cannot arbitrarily enter a trade with any quantity. Okay, so there should be some formula to calculate this quantity to manage our risk. So let's take a look at what are those things can be. Okay, so the first thing is that you have to determine your capital. So this is the first thing. So you decided that your capital is 100,000 rupees. It can be dollar, it can be $100, it can be $1,000, it can be $100,000, it can be rupees, anything, any amount. But you need to be at least you fixed this capital for a certain period of time. So today you are trading with 100,000, but tomorrow you cannot increase or decrease it arbitrarily. So you have to give a fixed amount of time to calculate this trade. And next, second is, what is your percentage of risk per trade? This is important. Okay, percentage of risk. So 1% is very much decent. I will not suggest to go after greater than 1% risk, but some professional trader they use 2% or 3%, but 3% is the max. I'll not suggest more than that. Okay, so this is what you need to determine. So let's say you assume that you will only take 1% of risk of your whole capital. Now you need to calculate the position size. Position size means the number of shares that you need to buy or sell. When you are entering the trade. So what is the formula? It is the percentage risk per trade of the capital divided by risk per share. So let's take an example. Let's take the example, the above example, that you have entered the trade into 100 rupees. You are targeting 120 rupees and your stop loss is at 90. Okay, so here our R, this means the risk. What is the percentage of our risk is basically we will determine as a 1 hour R. So here 1 R is our 1%. Okay, so how much are actually risking? You are risking per share is the 10 rupees, 100 minus 90. And how much you are willing to gain from this trade? If this is a win, so it's a 20 rupees. So there is a thing called risk to reward ratio, which is called RR. Okay, RR will be how much you are willing to gain divided by how much you are willing to lose. So here in this case, it is the RR is 2. So risk to reward ratio is 2. So this you have to make sure before entering any trade, after doing this calculation, that your risk to reward ratio is greater than equals to 2. I will suggest to have it at 2, but at some point of time you can make it 1.5, the risk to reward ratio, but not below 1.5. But 2 is the minimum amount that you should look. If the risk to reward ratio is not coming as a 2 or even 1.5, don't enter the trade. So this is the risk to reward ratio you need to finalize, and also you need to finalize the percentage of risk. So in this example, how many shares I can buy, I can enter with? It's basically, so 1% of 100,000 equals to 1,000, and risk per share here is my 10 rupees, right? So 10 rupees. So my quantity will be 100. Why? Because 1000 divided by 10 is 100. So now let's take one more example. Let's say you are entering a stock at 800 rupees. Stop loss is at 840. I'm sorry. Your target is 840 and stop loss is at 820. So your 20 is basically your risk per share, and 40 is your profit per share, target profit per share. So here also the risk to reward ratio is 2, correct? So we are good with this trade. We'll enter this trade. Fine. Now we need to calculate the number of shares. So it will again be 1000 divided by, we are taking 20 rupees per share is a risk. So 50 will be my quantity. So I will enter the trade with 50 quantity. So not any arbitrary number. You see here there is a calculation involved here. So now once I determine the number of shares, I'll calculate the expectancy per trade. So what is the expectancy? Is how much profit I am expecting. So there is a calculation that is the percentage of win of average win minus percentage of loss of average loss. So what does it mean is, so what is the average win? Average win means we are targeting 2R here, correct? So 2R here means our risk to reward ratio will be 2 here. So 2% of our own capital is the 2000 rupees is our average win. So every time we win, at least, so this is the, remember this is the minimum, correct? So every time we win, we are targeting minimum 2 risk to reward ratio 2R over here. So it's a 2% of 1 lakh is 2000. What is my loss? Average loss. How much maximum I can lose? It's a 1% of our capital, right? So that is a 1,000 rupees. So remember, so this is max. So this is the loss. We will not make our loss beyond 1,000 rupees, but we can win. When we win, we can make profit more than 2,000 rupees because this is the minimum one. So now coming to this formula, and let's assume that you win 50% of the time and you lost 50% of the time. So 50% of 2,000, which is the average win, minus 50% of the average loss, it becomes 1,000 minus 500 is 500 per trade. So this is my expectancy. Imagine that you are having 10 trades per month where you win 50% with this formula and then lose 50%. So your expectancy is 500 per trade. So 500 into 10, there is a 10 trade, means 5,000 per month. So this is what your expectancy is. So return on capital is, you are actually gaining 5,000 per month. 5,000 divided by your total capital is 5% per month, means 60% per year, which is a pretty decent amount for a trader. Okay, so if you maintain this formula by minimizing your risk to only 1% of your capital, and then you apply this technique, then you can actually make your trade profitable. But don't void this trading setup. So you can see here that there are three things that actually helps you to profit more. What are those three things? Which is, one of the thing is very obvious, that is percentage of win. So if you win more, right? So here the calculation will have, you can have more profit. One factor, right? Second factor is risk to reward ratio. If you target more risk to reward ratio, like if you are targeting 3R, so if the trade is below 3R, risk to reward ratio is below 3, you will not enter the trade. By doing so, you are actually maximizing your profit. And also you can maximize the number of trades by doing the number of trades, right? So all these three factors, but this number of trades is, I will not suggest, because you will only trade when the condition is favorable, right? So I will not suggest this part to take care, because in hurry you may lose. So then your percentage of win or percentage of loss, your percentage of win may come down. So only take the trade which is actually favorable in your this setup. But keep in mind that if you do the analysis properly, so you can make your percentage of win more than percentage of loss, or you are targeting more risk to reward ratio. Okay, so you are targeting maybe 3R, something like that, but your loss will be 1R. So remember that one. So this is how, these are the three factors that can help you to profit more from the trading. So one thing that you should know, that why we are talking this is that this is called a recovery trauma. Okay, so if you make a 5% of loss of your capital, let's say 100,000, so your capital become 95,000, and to bring back that capital to the original one, you need to make a profit of 5.3%. Similarly, if you make a loss of 10%, so your capital now becomes 90,000. So you need to make 11.1% of profit of 90,000 rupees to bring your capital back again 100,000. So here is the list you can look, right? So if you make 30% loss, so 70,000 is your capital now. So you need to make 43% profit. If you lost 50%, you need to make 100% profit to bring the capital back to the original one. Okay, so you can see that more you lose, then more you need to run for the profit to bring the capital back to the original one. Forget about the profit. Okay, so on that example that we have seen, okay, I have made one Excel sheet. you can download this Excel sheet from Google, or there is some website where you can calculate all these things. But take an example that you have a capital of 100,000, risk is 1%, so my risk amount becomes 1,000. So 1,000 risk is fixed for each and every trade, remember that. So in this April month, I have taken actually 10 trades, let's say, and then out of these 10, only 5 are lost and then 5 are wins. So it's a 50-50 win to loss ratio. Okay, so 50% of time I won, 50% time I lost. But now whatever my buy price is, whatever be my stop loss is, and remember that I am maintaining here the risk to reward ratio is 2. So my target profit will be accordingly, of course. So this is the minimum one. Okay, I can have the target profit more, and then number of shares is auto calculated from these things. So as you can see in all the losing stocks, okay, I only lost 1,000 rupees because that is the risk amount I have already put, and based on that my number of shares got calculated. But on all my profit winning trade, I made a 2,000 rupees profit. So my total profit is 10,000 rupees is the total of this total, and my total loss is 5,000 rupees, which is the total of this column. So my net profit and loss is 5,000 rupees at the end of the month if I take 10 trades, and out of this 50% is win, 50% is loss. Now you can see this scenario. So if I increase my win percentage, let's say this one I win, okay, so now it's a 60-40, I win 60% of the time, and also my profit becomes 8,000 rupees of my capital, so it becomes 8% per month. Earlier it was 5% per month, right? So I'll make it loose. Now if you bring down your risk to reward ratio to 1.5, so let's take that calculation. What will happen here? Okay, so you can see here now your total net profit and loss becomes less because you are now targeting risk to reward as a 1.5. So 2,500 per month is your net profit. Still you will be profitable. So 2.5% of your total capital is your net profit. But remember one thing, the more you bring your risk to reward ratio down, so if it is not below, of course, 1.5, so you need to make sure that you are at least winning 50% of the time. From this example you can see here, or you need to increase your number of trades. But whatever be it is, you have to be careful with this risk to reward ratio. I'll suggest to make it 2. Now next thing that I wanted to show you, if you are using the investing.com website, the chart for your trading, you can actually use this technique over there. Let me show you how. So this is the Bajaj FinServ chart, okay, and I can see that this is in a very good support level. Let's assume that I want to enter a trade. How do I enter a trade with a trade setup like the one that we are already discussing? Is actually here you can see in 43, the current price is at 43.90 almost, and let's say you want to buy it at 43.50, okay, and then your profit target will be maybe the peak of this candle at 5100, and your stop loss will be the low of this candle maybe at 4100, let's say. So there is a drawing tool over here in investing.com. That is the long position for the long position, short position for the short selling. So here we will be doing the long position, we will be using the long position here. So I'll click the long position and click over here, okay. So as you can see here, it gives me the tool. Now I'll go to the properties over here, and then I'll make my account size accordingly. So I'll make it 100,000, and also the risk accordingly. So it's just now 1% of risk, okay, I am taking. Now I'll go to the coordinates. So now we know that the entry price is basically at over here. So 43.50, let's say, is my entry price. It's 43.50, and we are targeting 5100, and also the price the stop loss. This is the stop loss, right? So it was around 4100 is the my stop loss, or maybe 4050. I'll put it 4050 is my stop loss, little lower than this candle wick. Okay, so if I click OK, now you see here the risk to reward ratio is automatically calculated. How? So your stop is 300 points, but target is 750. So 750 divided by 300 is 2.5. So your risk to reward ratio is automatically calculated. And based on your capital, based on your account size, the capital, okay, it's telling you that you need to buy only 3 quantity. Fine. So this is how also you can use this tool to calculate your quantity, how much quantity you want to enter with into that position. You can use the same tool when you are doing the short selling, but there remember the calculations are reversed, because there the entry price is basically your selling price, then the stop loss will be higher than the selling price, and your target profit will be lower than the selling price. But the things are same over there. So you can use this video and you can understand this technique that I have explained to you. You can go through this video once again to and listen carefully what I have said, and also you realize the importance of number of shares over here. Okay, how to calculate, and don't invalid your trade setup like this. Okay, always be in this framework, be in this process. So and if you be disciplined, then obviously you can make a good win, good profit at the end of the month. I hope this video was helpful to you, and thank you very much for watching. If you like this video, please click the like button in YouTube, and subscribe to our channel, and please share this video with your friends. Thank you very much for watching.